Hello and welcome to our webinar on market regulation and insurance department perspective. My name is Vaughn Lawrence and I'm the Director for Communications and Technology at PAMIC. As an organization, PAMIC is focused on providing timely education to our members about issues that directly affect their companies. Today we're focused on market regulation. Before we begin, I wanted to take some time to thank our sponsors. Premium Gold sponsors help to make all of our education possible throughout the year. So I just want to name off who those sponsors are. That's Baker Tilly, Donegal, Jen Ree, Guy Carpenter, Markham, Munich Re Hartford Steam Boiler, Mutual Boiler Re, Pennsylvania Indiana Lumbermen's, Swiss Re, and Willis Re. Now I'd like to introduce our presenters. Today we are very fortunate to have Christopher Monahan speaking with us from the Insurance Department. He currently serves as the Deputy Insurance Commissioner for the Insurance Department's Office of Market Regulation, where he oversees the Bureau of Consumer Services, Market Actions, and Enforcement Producer Licensing. He and his staff ensure consumers receive the protections they deserve under the laws and regulations of the Commonwealth, and the insurance industry is provided with a level playing field to compete. Today we also have Joel Hopkins, and he's a partner at Saul Ewing. So now we're going to throw it over to them, and we will begin our presentation.
All right, well, thank you very much. And I will tell you, we're extremely happy that you could take the time to do this. We know you've got a very busy schedule, and this is a great opportunity for PAMIC's members to really hear from you directly and get your insights. So thank you very much for your time.
I'm glad to be here. Thank you.
Thank you. What we're going to do is a little bit of a Q&A, and I was thinking before we started, I'm going to call this one Cross-Examining the Examiner. So I'll try not to be too tough, but if I shift into litigation mode and I get aggressive, you'll know why.
That's all right.
But let's start out with, why don't you give us a little bit of your background with the department and what you do?
Sure. I've spent 29 years with the Commonwealth, and the entire time has been with the insurance department. I actually began in 1989 as a market conduct examiner, and that was the year that market conduct was created. So I was one of the 4 original members to market conduct in Pennsylvania. And I did that for a little while before I transferred into special investigations, doing more of the agent type misconduct cases. I actually then switched around in 1997 to market analysis, where I became a division chief. Eventually, under Ron Gallagher, who was the deputy at the time, he offered me a director spot in market conduct and market analysis. And I took that, and it was maybe 5 years ago that the spot came open for the deputy secretary or deputy commissioner, and I went there. So I've been doing this about 4 or 5 years now as a deputy commissioner, and I have consumer services, enforcement, licensing, and market conduct under me. So most of my career has been spent with the insurance department. It's a place that I've grown to know about the industry, and I had a little bit of experience prior to that with an insurance company, but most of my knowledge and experience with insurance has come through the insurance department career.
Great. Well, it's an extensive amount of experience, which is why it's great we can have sit here and kind of pick your brain a little bit on some of the issues that the PAMIC members have faced. Well, let's start out very broadly. If you were to kind of step back in all the years that you have been there, and certainly in the chair you sit in now, what really keeps you up at night? As one of the primary regulators, what makes you say, these are the things I wish that were different, or these are the things that I'd like to change?
So from the market conduct standpoint, I think the things that concern me the most, and actually for the PAMIC members, it really doesn't apply to them, but on the health side, we have a lot of things going on. But on the P&C side, I think there has been stability in terms of what the expectations are for the players in our market. But in terms of things that keep us up at night, it would be that we're applying the statutes and regs properly, that we're being consistent, and that we truly do have a fair and level playing field, not only for consumers, but for the insurance companies. On the investigation side, which also falls under me, I think the thing that bothers me the most right now is it seems like we have a lot of agent activity which causes problems through misrepresentation. But from the company end, And I know that's what we really have here on the webinar today, our companies, at least in this market. I've been pretty happy with the activities I've seen recently in this market segment.
Are there, focusing on P&C, obviously this being a PAMIC presentation, focusing on property and casualty companies, are there 2, 3, 4 areas when you think about the property and casualty industry, you say these are those areas where we see problems with non-compliance and things that we really could get out in front of and address?
Yeah, I think through a market conduct examination aspect, the 3 areas that we see the most pop up in terms of the highest error ratios or the largest number of violations, it typically deals with the underwriting aspect, where perhaps rating wasn't implemented properly, or policies are being canceled midterm for inappropriate reasons. As everyone knows, under Act 205 homeowners, there's not a whole lot of reasons to get off a risk midterm in Pennsylvania, and yet we still see that happen consistently through market conduct exams. The other things deal with more like disclosure. Are the proper forms being used? Is the proper disclosure being made? And then, even though it's been around forever, the Chapter 146 claims notices, the acknowledgement within 10 days, the status letters 30 days and every 45 days thereafter, they seem to be simple. They've been there forever, and yet they seem to be, when my market conduct teams come to me with exam findings, they always seem to be a little bit higher error ratio-wise than the other findings in the exam. So I would say they are probably the 3 key areas that I typically see through an examination finding.
Okay. And I guess a general curiosity, are you seeing a lot of repeat violations where you've dealt with this with a company and then you've come back and you see the company again in 3, 4 years and you're saying, hey, we're seeing the same thing over and over again?
Yeah, mixed bag. I mean, we definitely see that. I'm happy to report that there have been companies that have underwent market conduct exams, and then a few years later, we'll do a checkup on them, or we'll do analysis every year to see how ratios are looking. Or every once in a while, we will do a re-exam or a follow-up, and we have seen good results for the most part. There are examples of companies, though, there are cases of companies where they actually have been put under re-exam provisions in a consent order where they knew we were coming back in, and despite that, not only did the ratios not improve, they got worse. So,
Okay.
and I'm not exactly sure why that occurs. Sometimes it's due to management shifts within the company, but sometimes we will see that.
Okay. And one thing we didn't address from the beginning, I want to make sure that if anybody in the audience has questions, feel free to submit them electronically, and we'll do the best we can to get them to Chris here during the hour. Talking about violations, one thing that a lot of companies I know struggle with is self-reporting. If they do have an issue, or perhaps they are under an order and they realize, we've made a mistake here, we haven't fixed this the way we should have. How does the department view self-reporting, and I guess the better question is, how should the companies view self-reporting? Is that something they should be comfortable with?
I believe so. Ever since was a director and now a deputy, I try to stress with my employees and with the companies that I have a chance to interact with that communication is key. I think that there may have been a time where communication between market conduct and companies was more adversarial, but I truly believe the way the process is, and we can talk more about our process as we get further into the webinar, but I truly believe we've developed a process now where self-reporting is very important to me, and companies should know that I view that as an extreme positive. If a company comes to me and says, hey, guess what, Chris, we got rates approved in Pennsylvania, and 6 months ago we went to implement them and the IT department did it wrong, and now we found that we're overcharging some consumers, we're undercharging others. For the company to come to me and tell me that and say, hey, what should we do? And we say, well, let's work together. Let's get refunds or credits. On the undercharges, we won't let you catch up premium, but you absolutely correct it from this point going forward. I have not had a case yet where we've resolved that through a settlement or a consent order. It's simply, let's fix it, get the money back to the consumer, let's move on.
So you're saying that the self-reporting is really a way to get out in front of it, and I would assume anyone listening to this is saying, well, gee, I'm afraid of a penalty at the end of it, but I think I'm hearing you say that's not necessarily the way they work.
It's not necessary, especially for the cases that we've seen most of the self-reporting taking place, and that is using wrong forms, using wrong rates, processing claims in a way that at the end of the day you realize, oh, we applied the wrong standards, there's more money due. Those are types of situations where we're looking for corrective action, consumer remediation, and we'll move on. Now, I can't guarantee that someday a situation won't arise where someone self-reports and says, you know what, Chris, we midterm canceled a block of 1,000 homeowner policies, and now none of those people have coverage. I think in that situation, I'd say that's great, but maybe we do need to dig a little deeper. So I can't guarantee every self-report will result in no examination, but for the most part right now, that's the way it's been going.
One of the issues that kind of ties into self-reporting is the concept of blind inquiries to the department, where companies might have some questions or confusion. Is that something you encourage companies to do, either through a trade organization like PAMIC, perhaps through council? Is that something?
Absolutely. Absolutely. And PAMIC is a really good resource to use for that. And, the one thing that I had taken notes here today, and I was going to save it for the end, but this is a good spot to talk about it. And that is, look, there always are questions out there about how we view things. And what my suggestion is to, put your questions together, either send them in to me or go through PAMIC. And it's definitely something that we'll consider putting some sort of guidance out, or if it's an individual response because it seems to be unique to that company, we'll definitely try to help.
Okay. And in the future, if something comes up, how, I know when I have gotten those sorts of responses, the department always puts a little disclaimer to it.
Yes.
But I guess what I'm saying is I'm hoping that if the company follows that guidance, that in the future, if there's a problem, the department will take that into consideration.
As long as I'm in this role, if a company is ever cited through an enforcement case or a consumer case or a market conduct case, and they can show that they were simply following guidance, whether it was a formal approval from our policy review area, or it was guidance provided by legal or my area, look, it may result down the road if we have a change in policy or we determine we were wrong at that time. It may result in another change in policy, which would be unfortunate. But as long as I'm in this role, I would not try to build a case off something like that.
And that's good to know that the companies can be proactive and they don't have to be fearful, and they can take that information and rely on it.
And I mean, I think this is a good point too to say from my perspective, and I think I have the support of the front office in the insurance department. I believe there are certain regulators out there operating across the country who do have the idea that, the more errors they can find, the more violations they can find, the more penalties they can bring in, that's a good thing for the state. There are agencies out there, insurance departments around the country, that are funded through their penalties. I am not. My funding goes to the general fund, and I don't keep any of the penalty dollars at all from my budget. And even though the department's dedicated funding, we keep the money that comes in through appointments and licensing fees, not through enforcement. So from my perspective, I really don't get motivated to try to go out and run fines up. Obviously, sometimes they're needed to gain someone's attention, but it's not really a goal to just drive penalties through the roof.
And that's actually gives me a good segue into a very difficult area. I know it's something we struggle with representing companies, and I'm sure the companies struggle with, and that is the amount of a penalty. For as long as I have been doing this and as many as I've been through, I don't know that I've ever given any good advice to anyone as to, what goes into the penalty. Is there any math? Is there any science? So can you explain a little bit how the department determines what the penalty is supposed to be, or what the penalty is that's proposed at the end of an examination?
Sure. And so when I was director and Ron Gallagher was deputy, we came up with a process of trying to use a little more analytics. And it's not always that easy because every exam is unique. Every exam is different. But we tried to develop analytics where you take the maximum violations or the maximum penalty allowed by law for that exam. And they can be significant, millions, if not tens of millions of dollars under the law. But we'll take the maximum penalty. We'll look at error ratios by section. Certain sections hold more weight to us. the law doesn't say it, but we do. Like, for example, if we find that a form didn't have the right form number in the bottom left-hand corner and the maximum penalty is 200 grand for that section of the law, I'm probably not going to assess a whole lot of fine for that. Just fix it. On the other hand, if we find a company using claims processes where claims are inappropriately being denied, that's going to hold a lot more weight in defining a penalty. So what we try to do is maximum penalty, error ratios, what was comparable in the past? Was there an exam of a similar nature with similar findings? How did we resolve that? And so we take all these things and blend them together and come up with something we hope to be reasonable, that if we do get pushback, we can try to defend it.
Has the department considered perhaps providing a little bit information? Just listening to you, I realize that whenever my clients see a penalty, they don't really get the analytics that you just described. There's not really a, hey, we're focused on this versus that. Has there been any thought about perhaps being a little bit more transparent? And quite frankly, not every violation carries a penalty either.
No, that's
correct. So has there
correct.
been any thought at the department about perhaps trying to give the companies a better degree of comfort and more information so that they can say, I see where you're coming from, and then you kind of start negotiating from an equal footing?
Yeah, I don't think so much that we've thought about having some sort of a schedule or some sort of a table available for companies to look at. However, I will tell you that during the course of the examination, if a company has questions like that, we've already given companies examples of, hey, go to this examination report. It's online. Look at it. You're going to notice that the error ratios, the types of penalties noted are very similar to yours. And that's the other thing I suggest that companies do also is, in preparation for that final conversation with me or my staff, take the time to look at exams over the past 2 years and see if you can't pull out companies that are similar in nature, with similar business, with similar findings, and see what we did to them. Because I am willing to listen. I mean, our process, we try to do as good as we can to get it down pat, but we're not perfect. We may be missing something, and you guys could say, hey, here's another company and you didn't do the same thing to them. I'll listen to that.
That's very good to know. I note that we have a question from an audience member, so let's go ahead and take.
Yeah, we had a question for Chris. This is on the topic of self-reporting. They wanted to confirm that a company won't be fined for self-reporting. If he cannot do so, what is the advantage for a company to self-report versus fixing the issue on their own?
Okay. So what I can confirm is that self-reporting is a big deal for us. If a company's being proactive and self-reports, it's going to show me that the company is actually looking towards compliance. I can't guarantee that there'll never be a fine. I think we talked about certain situations where I could envision potentially there being an exam, but to date, for the most part, we have not been fining companies. In terms of what, that was a good point, in terms of what the benefit would be for self-reporting as opposed to trying to just fix it and then hope that nobody gets caught. From my perspective, I know if I were to do an analysis piece or get a consumer complaint and identify the issue and then have to go to the company and realize that they already knew about it and didn't tell us, that would result in a market conduct exam. Just because at that point, I've lost confidence that everything that's going on is something we can talk about. So self-reporting is huge. It's a way to avoid an exam, no guarantee, but if you don't self-report and we catch it, then I'm probably going to send in the auditors to figure out what happened.
Okay, very helpful. I note that we have another question, so let's go ahead and take that other question.
Yeah, the next question is, if an agency terminates their contract to write business with the carrier by mutual consent, can the company non-renew homeowners policies currently on the book for that agency?
So if an agency contract is terminated, the question is, can the company non-renew that agency's book of business? No, I mean, the book of business technically is at the company's end. So more than likely what would happen is the agent would have the chance to go out and replace that business legitimately with new carriers. But if consumers so chose to stay with the existing company, then that's their right.
And they would just do that either through direct writing or perhaps
A new agent.
a new agent.
Yeah, you very well may find a letter going out from the company to the consumer saying, hey, your agent no longer represents us, but here's a list of local agents.
Okay. Well, let's kind of one last area on the penalties. Now that we know it doesn't go into your pocket, so to speak, what do you know what the total penalties collected in 2016 were?
So it was about $3 million for 2016, of which about 2.2 million came from what we call multi-state examinations. So I'm sure the members out there are aware that Pennsylvania is an active participant in the National Association of Insurance Commissioners. And one of the things we take active roles in is the Market Actions Working Group, or MAWG. And it's through MAWG that national examinations are run when an issue is identified in the market where it is believed that is a national issue for a company. So rather than having 40 or 50 separate exams conducted all across the country, MAWG will get together and create one multi-state exam. They'll name 4 or 5 regulators across the country to help lead it. Pennsylvania leads quite a few of them. And at the end of the day, there'll be a settlement. And typically what happens is whatever the settlement is based on market share, and you get that percentage of the fine.
Okay.
So 2.2 million of our 3 million last year came from multi-states. 800,000 came from both enforcement and market conduct penalties, just PA specific activity.
And that money goes, I think you said earlier,
To the
right,
general fund. Correct.
Okay. Well, you talked about cooperation with other departments. I guess that leads to a couple of questions. And number one is, how does the Pennsylvania Insurance Department communicate with other insurance departments if you have carriers who are operating in multiple states? Is there kind of a hotline phone where someone says, hey, guess what they've done here? Or were you contacting, you reach out to other states? How does that work?
Yeah, so MAWG, there's 16 states who are actually active members of MAWG, but all states have the ability to listen in and provide comments to MAWG. So that is a key resource that we use at the NAIC to communicate. And, we meet monthly by phone, and then the committee or the working group also meets at the 3 annual national meetings, the NAIC meetings. Beyond that, there are multiple web page type issues where you can post information. There are distributions through email threads and email chains where we get notification from other states that we will actively communicate on for both market analysis, enforcement, and market conduct issues. We don't so much, when it comes to PA specific individual cases, communicate much with other states, just because I think the PAMIC members would agree there are certain provisions that are unique to Pennsylvania. Mm-hmm. Tort, limited tort. Sure. On the homeowner side, the inability to midterm cancel for pretty much anything other than, material misrep, fraud, or non-pay of premium. So when we're doing an exam on those kind of things, it really doesn't help us to reach out to other states who never even heard of limited tort. So, for the most part, when we're doing our own individual exams, and it seems to be a PA-specific issue, we'll stay within our state.
If you find out that another state is looking at an insurer who also operates in Pennsylvania, and they're looking at a specific issue, does that all of a sudden put that company on your radar for a potential targeted exam? Do you follow what's going on in the other state with your company? How do you do that?
We will follow. I mean, every time that an investigation or an examination is resolved around the country, we get notification, we get copies of the settlements and consent orders. What we do is we rely heavily in Pennsylvania on market analysis. Market analysis on an annual basis, we look at all 1,600 insurance companies that are licensed to operate in our market. We'll look at things like change in premiums, change in reserves, complaint indices, and activities in other states. But before it even gets to a level where we think about a target exam, we will actually look at market analysis. And if we're not seeing complaint activity, or the complaint activity is normal, if we don't see trending on huge increases in premiums or lawsuits against the company, it probably will just get thrown into a monitor status.
Is the MCAS part of that market analysis, the market conduct annual statement?
It is. MCAS is a big part of our annual review of companies, our annual analysis of companies. The data available through MCAS is not available to us anywhere else. When you look at lawsuits compared to claims closed without payment, or you look at policies non-renewed to total policies in force, those ratios aren't available on financial statements or anywhere else. So that data through MCAS is extremely important to us because it tells us things that we can't get anywhere else. So yes, that's a huge part of our analysis process.
So would it be fair to say that carriers should be very careful in
Very
completing
careful.
and make sure that it's thorough and that they're providing appropriate information?
Very careful. I'm not going to name the company. It wasn't a PAMIC company, but nonetheless, I have a story to tell everybody about MCAS and how it actually went awry one time in Pennsylvania. We had a company who reported data and it was horrendous. And so we wrote to the company and said, please explain what's going on. And the company wrote back to us and said, nothing. Everything we submitted is accurate. So we opened them up a market conduct exam and spent a couple months there. And at the end of the day, proved that the company was fine. And it was only then that the company said to us that all their data was wrong. Unfortunately, they spent a lot of money on a market conduct exam. And so what we learned from that is we will really probe when we see ratios that are off. We will really probe through interrogatories and pushbacks to make sure that the companies have a chance to tell us that what they reported is accurate. But I can tell you that states around the country other states don't necessarily push back. They'll look at a ratio and say, oh, they're midterm canceling 25% of the policies and send an exam team out. So that MCAS stuff is very important in terms of showing that you're operating within acceptable tolerances or ranges. But it's also very important from the standpoint, if you do report incorrectly, high or low, you can be making yourself a target.
Right, good. Well, let's shift gears a little bit and talk about the examination process itself. And I understand we have a question or two that leads right into that. So
Yeah, before I give the next question, I just want to remind everybody who's watching that this presentation and the contact info for these presenters will be available on our website after we're done here. And the next question is, how often will companies undergo a market conduct examination, and what is the average cost of a market conduct exam?
That's a good question. So, according to our statute, every 5 years, domestic insurers have to undergo financial examinations. It's required. So Joe DeMemo, the Deputy Insurance Commissioner for Financial Exams, knows that he has a schedule. A PA domestic company is going to be hit with a financial exam every 5 years. On market conduct, I regulate everyone who's licensed here. So it's just not 300 domestics, it's 1,600 licensed companies. Because of that, because I don't have enough resources, because it doesn't make sense to do examinations on a company that's doing nothing wrong, or so it appears according to analysis, we only use complaint, referral, or analysis-driven processes to identify targets for exam. And so last year, even though we have 1,600 licensees operating in the market, we only closed 16 market conduct exams. So the answer is, you may never have a market conduct exam. You may have one every 20 years. You may have one every year if you continue to do things incorrectly in the market. So a lot of it depends on what we find and how the company operates.
Okay. And the other part of that question, I think, was the cost. And I don't know if it was the average cost, but nonetheless, that's an important thing to talk about. So really, what is kind of the average cost? And we'll dig a little deeper there.
So, and we're going to, I think that we're going to start publishing the costs very soon. Whether or not there's a bill pending right now on transparency that would require both the financial and the market conduct segments in the department to report annually the expenses, not only for the PID employees, but for the vendors. But we've decided to just begin doing that on our own in anticipation of the bill passing. But I've also done some research, and it's not out there yet, but people are going to be able to see when we do start posting this. I believe that my most recent research showed that for last year, the average expense on a market conduct exam was $75,000. Now that was everything. That was vendor cost, PID expense, airplane tickets, because a lot of these will go to wherever they are. So if they're in California, we'll fly to California. But that was the total expense. That average may go up here, but not because of anything that PAMIC members are involved in. we have some massive Affordable Care Act exams going on, and they have been expensive. I've tried to control costs, but we knew they were going to be monsters. So that will drive the average up next year.
Yeah, I don't think I asked you this, but do you have any averages with respect to penalties as far as what the average penalty is for a company coming through an examination?
Well, 800 grand divided by, well, actually 200 grand of that was from enforcement. So about 600 grand divided by 16, whatever that plays out to be.
You're asking the wrong guy.
Yeah.
That requires math, but okay. Well, let's talk a little bit about the transparency bills and that are moving both through the House and the Senate right now. First of all, does the department, or do you have a specific view on whether you think that's a good idea? Is it going to help the process? Is it something that you think can really help the company start to control costs by, for example, having a sit down with the department before the exam begins and talking through and coming up with a budget? What's the department's view on that?
So I think the department's been supportive of it. I know my office has been. I've already instructed my division chiefs and my director in market conduct to begin doing the different provisions that are in there, to begin implementing and doing them already. So like the conference that would be required to take place before the exam that would talk about, is a vendor going to be involved? Who is it? Can the budget be presented for that vendor to the company to review? I've already instructed my staff to do that. I think that's a good thing. If anything, it also will show the vendors that, and a lot of times companies don't see this, vendors get a lot of pushback from my staff on expenses, because I don't like having our insurance companies just have expenses run through the roof. So that's one of the things that we really do put pressure on the vendor. I think what will help is when the vendors who do business in PA see that it's actually a statutory provision, it will help them understand that it's just not me putting pressure on them to keep costs down or suppress costs. It's something that we actually need to disclose. So I support it. I think that all the different processes that are involved with this, in terms of engagement letters being disclosed and working with the insurance company to develop a process that is the most efficient process, I like that. And believe it or not, it actually helps me retain staff, because no staff likes to live on the road, 12 months a year. And so the more work I can do from here in Harrisburg and save on travel, hotel, per diem, the insurance company putting us up in a conference room, I love that idea.
And that actually brings us to an issue that I think is common amongst a lot of insurers, and that is a real concern over the department's use of, you've been using the term vendors. If I say consultants, I'm sure we're talking
Right.
about the same thing. But there's a lot of concern that too much is being outsourced, and perhaps the department doesn't have the in-house experience to handle this. And as a result, costs can get out of control because things are being handed over to a vendor who is charging whatever that hourly rate might be, and charging, meals and all the different things. So I guess really my question is to the department's staffing and experience levels. Is that something that you see getting better in the next few years, where the department can hold a lot of these efforts and these works in-house, as opposed to putting it out to these vendors and consultants?
I believe that we are working on that. I believe that we've seen some positive results. We've actually seen a decline in the average expense for a market conduct exam. The same cost that I just indicated before, being around $70-some thousand, I tried to recreate some numbers, and it was kind of hard to do based on the fact that we hadn't been tracking it that way. But I tried to look at numbers from like 5 or 6 years ago, and I can tell you that the average expense, just based on what I could recreate, was over 100 grand per year. So we seem to have been able to control expenses, but at one point we were forced to be using vendors because we were down to only 2 market conduct examiners completely. That was for everyone: life, health, property, casualty. We are now up to 8 market conduct staff. I know that doesn't seem like a lot for the 5th largest market in the country, but considering the fact that we don't really rely heavily on market conducts, 15, 16 per year, we're getting to the point where we're feeling comfortable. These examiners don't have tons of experience in the Commonwealth, but they all came from insurance companies where they were underwriters and claims reps. So they do know about our market. And so I'm hoping that we can continue to develop these people and create some sort of a plan where, you know, as my chiefs and directors move into retirement, these people can assume roles and train new examiners to come in. My goal is to try to limit vendor activity as much as I can.
Do you have any room in the budget for additional headcount in your department?
Right now, I'm not so sure. I think that the last figure I heard was that the department's almost fully staffed. We are probably within 3 or 4 positions of being fully staffed, and I don't believe the 3 or 4 positions that are pending belong to me. But
what can we do to change that?
Well, I think it's something that we continue to have conversations. I think that the trade associations can continue to come in and have meet and greets with the commissioner, with the executive deputy, and with me, and let them know how important it is to have a strong market reg area. Not so much that, you know, we have so much staff that we're looking for stuff to do. I don't think the industry ever wants,
Right.
you know, market conduct staff sitting around with nothing to do so that we start. That wouldn't be the goal. But the goal would be to take the 16 exams to 20 exams we do per year and make them more efficient, get them done quicker, have them done right the first time. Because, you know, I've actually had market conduct staff on the vendor side look at files incorrectly. And so that was billed to the company. And just so everybody out there knows how we handle stuff, once we find that, I'll actually assign my own staff to fix it, and we won't bill for that. But I hate doing that. So my goal is to become more reliant on in-house staff. And if we could grow and train a good staff, that would be the best bet, because it's not always that easy to manage vendors.
Right. I would think most would agree with that. How are vendors selected? Is there an RFP process, or are there certain credentials that you look for? Who do we get doing these things?
So I believe it's like every 3 years, there's an RFQ process that we run through Office of Administration. And the vendors do need to submit RFQ binders with experience, with what they can do. And, you know, we work with Office of Administration and Budget to make sure that all the vendors qualify right down to the nitty gritty. And then we will formally approve or disapprove them. Once you're on the RFQ list, that's the only source we can use to pull a vendor. Getting beyond that, how do we identify a vendor for a specific exam? When we first started to do this, I think our philosophy was, well, let's be fair. Let's assign vendors on a rotating basis. That way, nobody looks like there's favoritism, like we're assigning any one vendor more cases or bigger cases than anyone else. But what we found there was that by doing the rotating basis, the exams don't always cooperate. So you could have a very large exam come up that's very critical and have a vendor out there that might only have, although they're qualified, 2 staff on board. And you give them that assignment and it's going to be a disaster. So right now what we're doing is we're looking at, do I have enough staff internally to do it on my own? If not, do I need a supplement with a vendor? I would prefer not to just put a vendor on alone. The vendors available, do they have the expertise in a certain area? Like if we're doing manual rating, what vendor's best at that? Does the vendor have the proper people available at that time to give those people to me? Because these vendors are doing cases all around the country. I don't want to wait 10 months till their people come available. So all of these things and cost come into play when we're trying to pick a vendor.
And are the rates, I'm not sure if you had addressed this, but are the rates the same for all the vendors, or are they?
They vary. They vary. But I can tell you, we've actually rejected RFQs in the past based on just rates, where we had a vendor come in with a ridiculous rate and we rejected the RFQ. So they don't do business at all here. But everyone else, like when you look at an examiner trainee at a vendor or an examiner one, they fall within a range of $50 from a median, or from an average.
Okay. Speaking internally on your staff, how are they trained? Is there any sort of accreditation standard that goes, maybe an NAIC standard with your people? How are they? Where do they get their experience?
So right now there is no market conduct accreditation standards, but we've developed for both the life, health, and the property casualty side, we've developed extensive training. We have developed all sorts of training manuals and processes and binders that help a new examiner coming in explain not only what the laws and the regs mean, but how you apply them, how you gain evidence or documentation through an exam. So we actually do all our own in-house training. Now, that's supplemented by other things. We'll send, there'll be courses that we can send them to, like the Market Conduct Manager course. We think that's an MCM course. We think that's an important one for them to go to. The IRIS seminars, we believe that's a good place for information. We'll send them to those. But in terms of actually having specific requirements or qualifications like the financial examiners do through accreditation, we don't have that.
Okay. I will tell you from my own personal experience, one of the things that I find pretty frustrating is if I'm working with somebody or the department issues a critique, and with my experience, I look at this and I say, boy, that's just not right. But I can't seem to get any satisfaction. I can't seem to make my point and convince the examiner that maybe they're seeing this the wrong way. When that happens through the course of an examination, is there somewhere to go? Is there something that we can do instead of just getting hey, go sit down and be quiet, and we'll tell you where this all ends up?
Yeah, certainly. That's a good point too. And I know we don't always see eye to eye during an examination. A company might interpret a law or a process differently. So what I suggest is, follow the hierarchy that we've established. So if you're dealing with an examiner and you've presented your arguments to the examiner and they just don't see your point, there should be a lead examiner on site. Run it through them. Beyond that, you have the ability to do outreach to the division chief. Division chief will bump that up to the director if they're not sure what to do. And occasionally those cases will get elevated to me as well. But there's definitely, we don't just want to go out there and say, we're not listening to you, your argument makes no sense. We do want to listen to you. And, but sometimes at the end of the day, as you're aware, we've been involved in cases like this where at the end of the day, we just aren't going to agree, but we have to figure out how to meet in the middle somehow. But I would advise companies to make sure, talk to the chief, talk to, if you don't get satisfaction there, talk to the director. Have someone explain to you why the explanations or the information that you're giving isn't resulting in the removal of a violation.
And that's very good advice, because I think a lot of companies, you're absolutely right. These things can be subject to different interpretations. The department has its view. I think most of the companies want to know that they at least can be heard, and that they have a fair opportunity to explain their position and have that position considered.
Yes.
And I think going up the chain the way you said is really good advice. That leads me to a question, something that has perplexed me forever, and that is exit summaries and the exit summary interview or meeting, I guess I forget what it's called now. What is the purpose of an exit summary?
It's a good question. So I think you have to take a look at what happens before the exit conference, I think is what they call it.
Thank you. Yes.
I get it wrong all the time too. That prior to the exit conference, there should have been multiple opportunities through the course of the examination for the company to be heard. So as an examiner looks at a subject or a block of files in a case, they'll present their findings to the company, and the company should have the opportunity to respond, either acknowledging the violation or saying, no, we think it's wrong, and providing evidence or documentation showing why. Those initial summaries and the responses are very important, and there's back and forth involved, because there might be 1 or 2 or 3 transactions or interactions where until we get to the end and say, you're right, we're going to remove the finding, or look, we looked at everything, but it's staying. That is a key point in the exam, because what happens is, as you're aware, when ultimately as you get towards the end of the exam, those initial summaries do translate into what we call the exit conference summary.
Right.
And so we both know that if you miss your opportunity during the initial summaries to make your point, the exit summary happens, and pretty much at that point, it's a solid document.
Right.
So one of the things that we always get asked is there no further consideration at this point to remove? I can't say at that point that there's no further, but I can tell you at that point, if the company has pushed hard enough on a subject. It has been vetted through me, and I've vetted it through legal, and we feel pretty confident that that's where it needs to be. The company may not agree with it. So when you do an exit conference, I believe the main point of that is to let the company know, here's what the department truly believes the final public document's going to look like. It still gives the company a chance to say, wait, we're not happy, but it still doesn't mean things are going to be changed. But at least from my perspective, what's important is I know from the company perspective what they still aren't happy with. I think from the exit conference standpoint, that's really the end thing. Both parties get to know, the company gets to know what's probably going to be on the exam report, and I get to know what, if anything's going to hold a resolution up, I know what that is at that point.
Okay, so it's probably more drawing the lines in the sand as opposed to, we're giving and taking and moving back.
I think so. I think so.
So then after the exit summary and the final report comes out, if we get to that point and there's been disagreement and there's still outstanding disagreement, what's the company's next step in that process?
So there's what happens at the end is when an examination report is issued, that begins a tolling time under law. We have 60 days from that point to resolve the exam. The company has 30 days to actually provide a response to that examination report. The response becomes a public document. After that, I have a 30-day window to resolve, and a couple of things can happen. If the company is willing to resolve it, even though they may not agree with everything, a lot of times companies will concede and say, look, we don't agree, but for the sake of compliance and moving forward, we'll make the changes. If that's the case, we'll move forward with a consent order. And now it's just a matter of what the terms are. But if we truly have sticking points, what I can do is I can reject the examination report as deputy commissioner and reopen the investigation and try to determine more what's going on, look at more files or whatever that may be. And then the last recourse is, we either take the entire case to a hearing. The company has a right to an administrative hearing, or I'm sure that it's possible, we haven't had a situation like this in a long time, that we resolve all the segments of the exam that we can through a consent order and take only those segments under dispute to a hearing.
Okay.
And neither party likes the hearing process because it can be timely and costly for both sides. So thankfully that I can't remember over the past 5 years, I don't remember any cases going into hearing.
Neither do I. And I think part of that is certainly the fear that, as you said at the beginning of this, if you really did the math and added up the fines, it could be, enormous dollars. Would that be the case that if a matter had to go to the administrative hearings office, that the department would say, well, you know what, that $30,000 I proposed is off the table, and now we're looking at $3-4 million?
Possibly. And I think because you follow the adjudication. So where my office gets more heavily involved in hearings is on my enforcement side.
Right.
Denial of licensing applications for producers, 1033 rejections for when we don't give a waiver for someone with a criminal conviction, or quite honestly, just a case involving a producer who may have misrepresented a product. Far more of those cases go to hearings. And I believe you've seen cases where, and no one knows this behind the scenes, but I can tell you, just high level, we've had cases where all I wanted to do was take the actor out of the business, revoke their license. Now, I know that's a huge deal. Mm-hmm. You're talking about taking someone's livelihood away, but I have a responsibility to protect the public and competitors. Right. I've seen cases where the producer refused to sign a consent order, so we took them to a hearing and they were revoked and got fined $75,000. So if you go there, you're rolling the dice because the commissioner may very well invoke the penalties too, or raise them up compared to where I have them.
Well, talking about kind of minimizing the exposure, if during the course of an examination something comes up and a company says, I hear you, I see that we're getting that wrong, how important or relevant is it to the department if the company takes immediate remedial action? Doesn't wait for the end of the examination, but says, thanks for bringing that to our attention. We're going to go ahead and fix that form or change that process.
That's big. And again, it gets back to what we were talking about before. There's no specific formula that we can actually come down and say, this will be exactly this amount of money at the end of the exam in terms of penalty. But that factors into penalty. If I have a company who has been reluctant to give me records, comply with recommendations, argues over everything through the course of it, I typically don't get insulted. This is my job. I don't take things personally. But when you're looking at penalties, that to send a message, the penalty might be a little higher than typical compared to a company that comes in and says, we not only heard you, but we already fixed it. We fixed it before you even issued an exam report. I'm going to hear that too.
Okay.
I definitely am going to consider that. And not even from a dollar standpoint. Think of it this way. Sometimes when we believe companies aren't getting the message, consent orders will include re-examination clauses where there's no doubt that within 18 months you're getting another exam. And it's going to cost a lot because we're going to look at everything that you were in non-compliance with. If we have a company who comes to us and says, we not only heard you, but we fixed it, you're not going to have things like re-exam clause and corrective action plan requirements. It could really play out well for the company who's taking the steps to correct the process beforehand.
Good. That's good to know. We're winding down here and we're getting close to the end. A couple of specific things I'd like to ask you about. One issue that I have seen and a lot of my clients have dealt with is the apparent disconnect between the approval of forms and then through a market conduct examination, the examiner will say you have a non-compliant form.
Right.
And the company will say, how can that be? It's already been approved by the department.
Right.
And kind of the last part of this compound question, they'll say, even if you're right and it's not compliant, don't I get a get out of jail free card because it was approved by the department? So if you can kind of share your thoughts on that, Ed.
That's it. That happens. And it's actually something that more recently we've been spending time trying to make sure that the different areas in the department truly do coordinate on these things so that sometimes it's not even so much that the form was approved in error. It could have been, and this is a horrible admission for me to make, but it could have been that the two different program areas had a completely different view on what the form was supposed to say. It wasn't simply an error. It was forms thought it meant one thing and market conduct meant it meant something else. And that's the worst scenario, where a company's being given approval and it was a thoughtful process on the forms end. We actually decided it was okay. And then market conduct's going to come out and whack you. And so I do take that into account. I try, again, if we believe that the form is inappropriate, we'll get legal involved immediately. Number one, to coordinate, make sure it doesn't happen again, that the two units within our agency are consistent. But from my standpoint, my goal is to make sure that there's corrective action. And I know it's hard for companies to understand this, and they're just going to have to take my word for it. When you look at a market conduct exam that has 40 different violations found, from rating to claims acknowledgement to unlicensed agent activity, you take all those different segments and they all have different sections of penalties, and it comes up to a total fine. There very well may be a segment of that exam that I do not use to build the fine at all. And the form area, that would be one of them, I guarantee you. If it was a dispute between our two offices, I'm not going to take it out. But the company may be asked to refile, but only after we decide inside of our office who was right and who was wrong. So
we're winding down and we'll hit these very quickly, but the department on the exam, the final report, oftentimes it addresses concerns, I think, is what they're, violations and concerns. What is the impact? What's the effect of having something be a concern on the final report?
So do you mean at the very end of the exam report, there's actually recommendations listed?
Mm-hmm.
Is that what you're talking about? Or are you talking about the concerns that may be listed throughout?
Correct. Yep.
Okay. So a recommendation, and I never liked this word, a recommendation is actually the corrective action. Mm-hmm. A recommendation isn't that we're suggesting you do it. These are actually what you have to do to meet compliance. The corrective actions that you, or the concerns that you identify throughout, are areas where we don't believe that a law or a reg has been committed, a violation hasn't been committed, but it's an area that maybe is causing consumer confusion, or it's an area that maybe is even causing confusion from within a company. We'll list it as a concern so that down the road, maybe the confusion's cleared up.
Okay. All right. Good. And then I don't think we have any other questions, but I've got one that might be a little bit loaded, and I'll let you trail off the hour with this. Over the years, the department has put out a lot of guidance in a lot of different areas. Things that are posted on the website, there might be bulletins, whatever it might be. And I think we could all agree that in some cases, those things have been inconsistent, or if you look at them now, they are a little bit outdated. Has the department ever considered, and this is almost me shooting myself in the foot, the complexity of what goes on in the state is probably good for me and my business, but has the department ever considered coming up with comprehensive guides, kind of cleaning up everything that's out there and saying, here's the current state of affairs going forward, and this is what companies can look to and rely on?
I think we have. I think we've attempted to clarify certain things, but in terms of like a comprehensive one-stop shopping site, that's a neat idea. But as you know, maybe easier said than done. I don't have enough resources to do it, but if I could ever get more resources, that would be something where you identify an issue or an inconsistency and do something to help clear it up. And maybe that's something that we work together on. I mean, maybe that's something that the PAMIC members bring to me or to my office and say, here are areas that we found where the guidance seems to be conflicting between, like what we were talking about before with forms. Form says it's okay, market conduct says it's not. Maybe we begin developing an active live product that we just build off to provide guidance. And I'd be happy to talk more about that. But right now, I don't think there's any one-stop place you could find.
And I think based on your conversation, the resources earlier, there's probably not a lot of people sitting around who can take that task.
I actually don't have anyone sitting around. So
okay, well, that was wishful thinking, and for that kind of my final point, my wishful thinking. So unless we have any other questions from the audience, and we'll take a second to see if any come in at the end.
Yeah, there's one more question. Would the department be willing to work with the AICP to help clean up the website?
Clean up
the website, the AICP, Association of Insurance Compliance Professionals, if maybe you could use them as a resource?
I'd be happy to talk more about it, but I believe, the Commonwealth has such crazy rules. We'd have to make sure that all of the vendors and the rules that we have to follow with that we would be able to do that. But again, I think this is something that we can talk more about, and we have a good relationship with PAMIC. I think this is something that the conversation can continue.
Good. All right. Well, not hearing anything else, I want to thank everybody. I especially want to thank Chris for taking time out of your day, and knowing how short-staffed you are. We're going to let you get back there and get back to work.
Yeah, thank you.
Thank you very much.
Thank you.
On behalf of PAMIC, I want to thank everybody for joining us for this webinar today, and we also really want to thank Joel Hopkins and Chris Monahan for being here and giving us such great information throughout this last hour. We're going to continue our webinar education next month in May with an interesting session on branding the modern mutual presented by Chris Orrell and Randy Fulmer of Donegal. And that should be a really interesting webinar. We hope that you guys join us for that. And again, we want to thank our premium gold sponsors for helping us to put this education forward. So we'll see you guys on May 23rd.